What's up, everybody? This is Jadrian, the Home Locator, aka your favorite realtor. Just want to say thank you for the support that you guys are showing. Before we start this video, I want you guys to share it, like it, and subscribe. Once again, share, like, and subscribe. Thank you. We out. Watch the video. What's up, everybody? Welcome to another episode of the Home Locators Community. I'm your favorite host and realtor, Jadrian Lawson, and I'm back with my guy, Mr. James Mack. How you doing, man?
What's going on, man? I'm all right. How are you?
I'm good, man. I'm good. It's been a long week, but we making it happen.
Right.
So last video, he gave us a lot of gems and nuggets that people, are educating themselves from. We got a video that went viral, got a couple thousand views. So I have a list of questions that people wanted to know from him, just in general. So I'm gonna dive right into it. So how does credit impact your ability to invest in real estate?
Credit impacts your ability to invest in real estate because when the bank can't see you, they see a number that's attached to you. So having good credit, it affects a lot of different things when it comes to buying a home. First thing is, how much home can you afford? So when they look at your credit, that's kind of going to tell the tale of, how much debt are you in?
Yeah.
Kind of tells the tale of what are you spending your money on?
Yeah.
So when they run your credit, it's going to tell how likely are we going to be able to get our money back from you from loaning you this money for this house.
Okay. And so when it comes to having quote unquote good credit, I just kind of want to throw this in there. Make sure that you have everything in order too. You don't want to go in to any situation thinking that you have it all figured out. And he just told me, a few minutes ago that don't go buy a car, don't go buy anything when you trying to make that initial investment because it's gonna screw everything up. So just make sure you listen to your lender, listen to my guy right here, and make sure you listen to your realtor as well because it's gonna benefit you more than it hurts you. So our next question that we had was, what specific aspects of credit do lenders consider when evaluating investment property loans?
It's the same. When it comes to buying investment properties, the main thing the lender wants to look at when you have investment properties on your portfolio, they want to know that those investment properties are performing in the positive. A lot of times people look at from the business perspective, hey, I've went and repaired this house for, $40,000 or $10,000, $5,000, and they write all of that stuff off.
Yeah.
Well, sometimes by the time you write off all of those expenses, then you hadn't left enough income. So when all of those numbers are figured out, it's like, hey, I know on paper you said you're collecting $2,500 a month, but by the time we take off, everything that you've written off as far as maintenance and, different line items, it shows you're actually negative $800. So one thing I had to realize early on that sometimes even when it was an expense, I did not write it off on my taxes because I wanted the lender to be able to view those homes as positive. So it's one of those things where, you can get a few dollars from Uncle Sam by writing it all off, but when you go back to buy your next home within that same year, those write-offs can come back and hurt you. So the rule of thumb is if you're doing LLCs and you got different, businesses outside of your W-2, don't write off all of your expenses because it could hurt you. So before you make a decision like that, definitely if you with a good lender, they'll give you that information.
Would you say that that's one of the misconceptions too? Is going ahead and writing off something, but also I would say if somebody has something in their personal, just like we talked about, and they're writing it off, do you think the misconception is you're supposed to have it in your business name versus yourself, or how does that I'm kind of asking it a little weird, but
Well, I get what you're saying. Does it matter if the income is attached to your business?
Exactly.
Or does it matter if it's attached to your personal?
Exactly.
Well, from the business perspective, the bank wants your business to be operating with a schedule. I believe it's a Schedule E.
Okay.
For at least 2 years. So I bought a lot of properties so close together that I didn't have time to move them over to an LLC because had I moved them over, the bank wouldn't even looked at it because it has to be in that category, in that business name for 2 years. So I just ran them all over with my personal. From a tax liability standpoint, you know, it's some different language and barriers that you could run into that, you know, negative because you may pay, you know, extra 10% in taxes because it's attached to your personal. But outside of that, it normally doesn't matter long as those properties are line item on your W-2 somewhere.
Okay. And also, another question that they had was, in your experience, what is the common misconception of having good credit when you're investing?
A lot of people think that you can buy a house just based on good credit. That's one aspect of it, but the other aspect is, have you been on your job for at least 2 years? Because the bank always wants to see 2 years of W-2s or...
You could experience the great outdoors in a whole...
All right, bet. In your experience, what's the most common misconception about having good credit when real estate investing?
A lot of people think that if you have good credit, that you can all of a sudden just go out and buy a house because you got good credit. Now you got to have good credit, and you have to show where you've been employed for at least 2 years. That can be through LLC, through a personal business. It don't have to be where you're a W-2 employee for say. But even if you have your own business, the banks wants to see that business has filed at least 2 years of tax return for them to consider that income. So a lot of people think, hey, I got good credit, I can go buy me a house, or they think that, hey, I make the money and I can go buy the house. So a lot of times, even when it comes to purchases, they get all of that misconstrued because a lot of people think that, you know, hey, I make $100,000 a year, so I got good credit. I can go out and I can afford, you know, a house. Well, by the time you add a $1,300 car note, you got credit cards that's, you know, costing you about $400 a month. All of that goes against your DTI, and the bank looks at that, and all of that determines of what you can afford when it comes to a house.
So, and this is a question for myself, in a way. So whenever you, let's just say if somebody just got a good job, right? And you moving up on how much you're making a year, the credit, I mean, as far as your credit goes and the lenders, they're looking back at what's previously and not what's in the future, right? Or is it go hand in hand?
It goes hand in hand because if you filed tax returns and it shows that, hey, you know, this year you made $50,000 a year, but then you got a raise or you got a promotion, you switched jobs, and now you're making $150,000 a year, the bank is actually going to consider all of that information. That's not going to go off your tax return because they're going to require you to probably provide at least 30 to 60 days worth of paycheck stubs. And that's what they call projected income. So they're going to be able to project what you're projected to make in the future, and they will take all of that into consideration.
So that kind of goes, it kind of mirrors the same way that the lenders look in the car business too, right? So like if you had a job that you can't necessarily afford this expense for this car, it's the same thing for a house too.
Well, cars are a little different because I can only speak from experience. I mean, cars, when you go buy a vehicle, the car company is not necessarily looking at quote unquote your house payment. They'll let you run up at your car and you be 80% of your check gone, and they'll let you go ahead and get into that vehicle, knowing that it's gonna be a struggle.
As long as it's a sale.
As long as it's a sale. So kind of car buying is a little different, but
true.
That's a different that's a different conversation for a different day. But I will say, do not go into the dealership and let them run your credit. Already get outside financing before, because then you ain't got to go into the bank or to the dealership and they running your credit 40 times trying to find a lender who will take you with this all right credit.
Yeah, that's a gem right there, because a lot of people do go into car dealerships and get taken advantage of.
Oh, yes,
so
most definitely.
Watch out for that. So how does creditworthiness influence the type of investment properties that you can purchase?
You got to. It doesn't necessarily affect it, but again, it goes back to earlier. You gotta show positive cash flow.
Okay.
So as long as you're showing positive cash flow and your credit score is high, what the bank don't do, they call it reserves. So just say if you got 10 properties, sometimes the bank will say, hey, we need you to have $60,000 in reserve in case somebody don't pay their rent. Somebody don't make a payment to you. We need to know that you got a cushion to be able to make those payments on their behalf. We're not going to be out here loaning money. You can't get your money, we can't get ours. It doesn't work like that. So, but when you have good credit and you've maintained good credit, then that reserve amount decreases.
Okay.
So I remember going into a situation maybe with my third or fourth rental property, I didn't have credit in the almost 800s.
Yeah.
So what happened was they said, hey, well, we need you to have, $80,000 in reserves based on already what you have going.
Yeah.
Well, it was what it was. That was part of the underwriting criteria. But as I grew my portfolio and my credit score continued to go up, then that reserve amount, even when I got to property 10, it probably was 60% less than what it was at property 3 because I showed positive cash flow from every property from then to now.
Yeah. Okay. So it kind of piggyback to what you said before too, though. You had said that, keeping that 3 to 4 months kind of in the chamber just in case for those situations. I kind of wanted to refer to the last one because that stood out to me. But another question that I did have is, what advice would you have for real estate investors who may have encountered any challenges due to credit related issues in the past?
It's a couple of things. Credit is everything. Like I said earlier, people. If you ran my credit right now without seeing me, if it came across your desk, the only thing you have is a name, a social security number, and a number attached to it.
Yeah.
So without my face even being on the scene, you're looking at my credit to see how responsible I am, and that's telling a story on if you're going to give me any type of loan.
Yeah.
So what I suggest to people is maintain your credit. People get $10 hospital bills, $75 hospital bills, even $2,000 hospital bills. I don't want to get too far into credit and, what they look for and what they don't look for now as far as hospital bills. But a lot of times we just let those bills go to collection and it drags our credit score down when we can get on a payment plan sometimes for a simple $10 a month to keep that from getting on our credit to maintain good credit. So when you talk maintaining good credit, that's checking it, making sure, no errors are on your credit report, making sure you're just responsible in paying your bills. And if you have any challenges, then you have to go back to the drawing board, pull your credit, look at it and say, hey, what's on my credit that I need to, that I can do to improve my credit.
Yeah.
A lot of times people go out right before not even right before, but if you're looking to buy a house, next year, don't go out and get a car for $1,300 a month because all of that affects your DTI on what you can afford. And when you got a vehicle, you got credit cards, and you got all of this stuff, all of that stuff tells the tales. It either increases your credit or it lowers it. So when you talk adding a bunch of bills before you get ready to purchase a home, those are things that could potentially hurt you when it comes to purchasing a home.
Okay. Yeah, because a lot of people do see this a little different, or they thought of it a different way, and I'm glad that you said that. But when you buying a car and you want to go buy a house, just make sure that bill is not, you can go, like you said, go get $100,000 truck or whatever the case may be, but you got to make sure that the payments are low. So rule of thumb, just don't go buy a car or don't go do anything extravagant whenever you are trying to purchase a house. So just make sure you're making the right decision. We can't tell you what to do, but we can give you game on how to do it. So
and just to piggyback off that, you can always figure out your DTI from sitting at the house, because it's not necessarily about the vehicle and the overall price of the vehicle. It's about what you're paying a month. And the bank wants you to be somewhere between 42 and 52% of what you're paying out. In income when it comes to purchasing a house. So by the time you add your vehicle, you add up the credit cards that you're paying a month, even if it's $13 a month, might be $100 a month, the bank is going to take all of that and say, okay, they're making $10,000 a month, but they're paying out $5,000 a month. And this is just what we can see on their credit report. We're not talking about light bills, water bills. We're talking about what we can see on the credit report. They're paying out $5,000. Well, that means your DTI, your debt to income, is now 50%, because you're making $10,000, but you're paying out $5,000. So that means you got $5,000 to work with in a house payment, and they only want you to spend no more than 52% of what you got left. So if you talk that, you say 52% of 5,000, you're talking about a little bit over 2,500. So right now in today's market, if you can afford, if they tell you, hey, you can afford a house, but it can't go over $2,500 a month, how much house you think you finna buy? You're gonna be looking for something that's around $200,000. And don't let you need a 3 or 4 bedroom, because automatically you probably kick yourself out. And if you find something out there, for $200,000 that you can live in, then definitely shoot this man an inbox. We need to go find it.
Exactly. We're going to buy it right now.
Right.
That's hilarious, bro. So how do lenders? So I would say, how do lenders view credit history when assessing the risks associated with financial investment? We kind of went over that just now, but how do you think? And I just spoke with my lender about this as well. But how do you think that they look at it as far as whenever you are making all of these purchases? Is it a bad thing? Is it something that will hurt you as far as your name? Like how does that hurt you?
Let me tell you a lot of what I do. I have put my own money in my pocket a lot of times and use the bank's money. So it's not about how much you're spending. It's about how much you can afford to spend. And the bank always looks at, if you don't pay a $200 light bill, then why am I going to give you $400,000 to buy a house when I can't? You show that you're not responsible enough to pay these small bills. That's why people go through credit repair and go through getting their credit worked on before, because a lot of times we made these mistakes, 4, 5, 6 years previous, because we didn't have home buying in mind. Well, once we said, hey, I want to own a home, all of that past stuff that we wasn't responsible in doing, guess what? It's came back on us.
Man, so I'm glad you said that about getting your credit fixed. I don't know too much about as far as the building credit aspect of someone with bad credit and how they get it up, because I don't work in it. But I wanted to know, do you think, is there ways that people are kind of manipulating with their credit and it doesn't look good in the future when people are buying a house, or just in general, like getting their credit fixed and it still look bad on their end?
I mean, you gotta start somewhere. So it's not necessarily a bad thing when you getting your credit repaired, because credit repair is just saying, hey, it may be a bill that is honestly not yours. So when somebody repair it and they get that removed, typically the lender can't even see it was there. Because once it's actually removed, it's gone.
It's gone,
Credit score may adjust, it may go up, it may not. That'll be kind of a question for a lender, credit repair person. And most lenders do have in-house credit repairs, but just find somebody that you're comfortable with that do what they say and don't just sell you a dream.
My lender has one. He has one in-house that's really, really professional. Shout out to Ryan. He has one in house, and he said that you got to watch out for it's some out there that can hurt you more than help you. So that's what kind of why I asked that question.
Right.
But in your opinion, why is it crucial for real estate investors to maintain good credit throughout their investment careers?
If you want to keep going,
yeah,
a lot of people get it misconstrued. I want to early on in my career, I'll say, hey, I'll use my own money. You know, I don't typically won't use the bank's money, but now that I've kind of got in it, and done learned and picked up a few nuggets, you want to maintain good credit, because at the end of the day, when you don't have credit, when you don't have cash, credit is all you got. So if you ain't making a bunch of money, and you.
All right. So lastly, why is it crucial for real estate investors to maintain good credit throughout their investment career?
You run out of cash, then credit is all you have.
Yeah.
So if you've messed up your credit for whatever reason, and life happens, it happens. So not a bad thing if for whatever reason, hey, you went out and got something at the time you can afford it, but life got to life in, and then it got to a point where you couldn't afford it, then fine and dandy. But we need to make sure you're maintaining your credit, especially if you're talking long-term career-wise, because, if like right now, if I go out and do something crazy with my credit, then the next property that I get ready to go to bank and try to get financed, they're going to look at me and say, well, you know what, your credit score was at 800, but, this has got on your credit, so now it's down to about 650. At that point, you don't qualify. So good credit helps you qualify for whatever it is you want in life, whether it's a house, car, rooms to go account. It's stuff out there, man, that it's a benefit of having good credit.
Okay. So that's it for the questions that I have, but I really do appreciate you sitting down with me today. And like I said, if y'all have any questions as far as either investing or you want to buy a house or either both, just hit me up. You can always reach me on Instagram, Facebook, and YouTube. Like, subscribe, and share. Tell a friend. We will be back. We will be here every other week, so you guys can get some good gems from not only James but myself. So I appreciate you guys for checking it out. We out.